Have you ever looked at your bank account balance and felt a deep sense of pride in that number staring back at you? Perhaps you have spent the last 30 years working diligently, saving every penny, and watching those digits climb higher and higher. You might believe that you are building a solid fortress of financial security for your retirement. However, the reality I am about to share with you might be deeply unsettling. Keeping too much of your wealth in a traditional bank account in 2026 is likely the single biggest financial mistake you are making right now. You see a stable balance on your screen, but the true purchasing power of that money is evaporating while you sleep. Imagine inflation as a silent thief that enters your home every single night. This thief does not take your furniture or your jewelry. Instead, he slowly shrinks the value of the dollars sitting in your wallet and your bank account. If you had $100,000 in 2021, by today, in 2026, that same amount can only buy what $80,000 could back then. You have essentially lost the value of a brand new mid-sized car without ever spending a single cent. Think about the feeling of security you get when you log into your banking app. That nice round number makes you feel safe, doesn't it? But that number is an illusion created by a system that relies on your lack of financial awareness. In this discussion, I am going to reveal the exact amount of cash you should keep in the bank to stay safe. More importantly, I will guide you on exactly where to move the rest of your capital so that it actually starts working for you. Do not let the banking system grow wealthy off your hard-earned savings while you are left with less every year. It is time to pull back the curtain on how money really works in this new economic era. Most of us were raised with the idea that the bank is the safest place for our money. Our parents and grandparents taught us that a big savings account was the ultimate goal. But the world of 2026 is very different from the world they lived in. We must understand that banks are not non-profit organizations or public services. They are master businesses that thrive by using other people's money to generate massive profits. When you deposit your savings into a typical account, you are effectively giving the bank a very cheap loan. They take your hard-earned capital and lend it to other customers for mortgages and car loans at interest rates that are 10 times higher than what they pay you. They invest in assets that generate significant returns for their shareholders while giving you a tiny fraction of a percent in return. In the current economy, many traditional banks are still paying interest rates that do not even come close to the rising cost of groceries and healthcare. If your bank pays you 0.01%, but the cost of living rises by 4%, you are effectively paying the bank to hold your money. People often think that keeping cash in the bank has zero risk because the number stays the same. But the greatest risk of all is the risk of losing your ability to buy things in the future. This is what economists call the erosion of purchasing power. There is also another factor that many people overlook, and that is the limit of the Federal Deposit Insurance Corporation protection. If you are keeping more than $250,000 in a single institution, any amount above that limit is completely unprotected if that bank faces a crisis. We have seen major financial institutions struggle in recent years, and you cannot assume that every bank is too big to fail. You have worked too hard for too many decades to leave your entire legacy in the hands of a system that does not prioritize your growth. Let us dig deeper into why we feel this emotional attachment to cash. For many of us, cash represents control. We like knowing that we can go to an automated teller machine and pull out physical bills if we need to. But in 2026, we are moving closer to a fully digital economy. The convenience of having money in a checking account makes it very easy to overspend on things we do not need. When money is just a digital number in an easy access account, it flows out of our lives much faster than we realize. By keeping too much in these low-interest accounts, you are also falling victim to what is known as the trap of convenience. The banks make it so easy for you to stay because they profit every single day. You do not move your money. So the big question is, exactly how much is enough to keep in cash? The answer lies in the golden rule of the emergency fund, which suggests keeping 3 to 6 months of your actual living expenses. Please notice that I said living expenses, not your total income. To calculate this, you need to be very honest about your monthly outflows. Think about your mortgage or rent, your property taxes, and your various insurance premiums. Include the cost of healthy food, which has become significantly more expensive in the last few years. Do not forget your utility bills, your phone plans, and your basic transportation costs. If your household requires $5,000 every month for these essentials, then your safety zone is between $15,000 and $30,000. This specific amount is your financial oxygen mask. It is there to protect you against a sudden medical emergency or an urgent repair to your home. It gives you the ability to breathe if you suddenly lose your primary source of income. But every single dollar you keep beyond this 6-month mark is essentially being starved of its potential. Let us look at a simple calculation to show you the devastating impact of this missed opportunity. Suppose you have $50,000 of excess cash sitting in a standard savings account for the next 10 years. With the current rates, you will still have roughly $50,000 a decade from now. But the world will be much more expensive. A gallon of milk, a basket of groceries, and a visit to the doctor will likely cost double what they do today. On the other hand, if you moved that excess capital into low-risk government bonds or high-yield accounts, that money could have grown significantly. By leaving it in a basic account, you are essentially paying a hidden tax on your own hesitation. This hidden tax is the difference between what your money could have earned and what it is actually earning. For those of us who are over 50, time is our most precious asset, and we cannot afford to waste it. In your younger years, you could afford to make mistakes because you had decades to recover. But as you approach retirement or enter your golden years, every dollar needs to be treated with respect. Every year you wait to optimize your savings is a year of compound growth that you can never get back. I understand that the idea of investing can feel overwhelming or even scary. The media often portrays the stock market as a dangerous casino where people lose everything. You do not want to gamble your life savings on volatile things like risky stocks or unproven digital currencies, and I completely agree with you. At this stage of life, protecting what you have is the primary goal. But protection does not mean doing nothing. Doing nothing is actually a guaranteed loss due to inflation. Instead of keeping depreciating cash, you should look for smarter and safer alternatives. The first and most accessible option is a high-yield savings account. These are often offered by online banks that do not have the massive overhead costs of traditional brick-and-mortar buildings. Because their costs are lower, they can pass those savings on to you in the form of much higher interest rates. Your money remains incredibly safe, and you can usually access it within a day or two. The second option is Treasury Bills, which are backed by the full faith and credit of the United States government. In 2026, these are offering some of the most attractive returns we have seen in decades for such a low level of risk. The third option is to consider low-cost index funds that track the Standard & Poor's 500. This allows you to own a small piece of the 500 largest companies in the country. History has shown that while the market has short-term ups and downs, it has consistently grown much faster than inflation over the long term. When you own an index fund, you are betting on the long-term success of the entire economy rather than one single company. The fourth option is to keep a small portion of your wealth, perhaps 5 to 10%, in physical gold. Gold has been a store of value for thousands of years, and often performs well when the paper currency is losing value. You do not have to change everything overnight if you feel nervous about the transition. You can use a strategy called dollar-cost averaging. This means you move a small, manageable amount of your excess cash into these assets every single month. This reduces the risk of moving all your money at the wrong time and helps you get comfortable with the process. Taking control of your cash flow will give you a level of peace of mind that a stagnant bank balance never could. Imagine the feeling of knowing that your money is working as hard as you did during your career. Imagine watching your net worth grow because you made the decision to stop being a passive saver and start being an active protector of your wealth. Remember that money is ultimately just a tool designed to serve your life and your family. It is a tool to provide you with health care, travel, and the ability to help your children and grandchildren. Do not let your tools sit in a drawer and gather rust while the world becomes more expensive around you. The banks want you to stay exactly where you are so they can continue to profit from your deposits. They rely on your fear and your busy schedule to keep their vaults full of your capital. But I want you to have a retirement that is filled with freedom and total independence. True security does not come from a pile of cash that is slowly rotting away. True security comes from having a diversified portfolio that grows over time. Right now, I want you to take a look at your monthly bills for the last 90 days. Calculate your true 6-month emergency number based on the reality of 2026. Look at your bank statement and identify every dollar that is sitting above that safety number. Be brave enough to move the excess into accounts that will actually protect your future. Stop letting the silent thief steal your hard work every night. Your future self will thank you for being bold and taking action today. You deserve to live a life where your financial future is secure and your hard-earned money is respected. The path to a secure and worry-free life starts with making your money work as hard as you did to earn it. Thank you for spending this time with me to focus on your financial health. I look forward to sharing more insights with you very soon.